So this is Chapter 9, Part 2. We've been talking about fixed assets. We talked about the characteristics of fixed assets. We talked about the cost of fixed assets and what to record and include in the cost of the fixed asset. We talked about a subsequent expenditure that we might make to a fixed asset and how to treat that in terms of whether to record that as an expense or to an adjustment to the asset account. And the next topic is once we've recorded that asset, we're going to need to depreciate the asset. And the reason for that is because the asset basically generates revenue over a period of time, and there was a cost involved in purchasing that asset and in generating that revenue. And so what we want to do is we want to allocate the cost of that asset to expense over the useful life of the asset. If we do that, so for instance, let's say we have a machine that's going to produce revenue for 5 years. If the machine cost us $1,000, what we want to do is we want to reflect the fact that using a straight line method, we want to reflect the fact that it's going to there's going to be a cost of producing that revenue, and we want to match $200 per year of that $1,000 against the revenue that it generates. So what we want to do is record depreciation expense of $200. If we do that for 5 years, we've allocated the full $1,000 of that cost over the 5 years that equipment has produced revenues. If we do that, then what we've effectively done is we've matched the expense associated with the machine with the revenue that was produced by the machine. And that is the essence of matching. And I think when I talked before in face-to-face meetings, we said that really almost the entire course is based upon the matching principle. And we talked about inventory in terms of matching costs versus revenue. The LIFO was the best matching method. In Chapter 8, we talked about accounts receivable, how recording bad debt expense was necessary to match the fact that we're going to have uncollectible accounts whenever we make a sale on account. And so we have to match that cost against the sale. The same thing here. When we buy an asset, we have to reflect the fact that there's a cost of producing that revenue, and part of the cost is reflected in the fact that we had to purchase an asset. So part of the cost of that asset has to be matched against the revenue. And so we do that by depreciating it. We do that by depreciating a portion of that cost each year, and then that depreciation expense gets matched against revenue, and that's obviously a critical concept in accounting. So the matching principle, once again, is critical to this whole concept of depreciation. So there's 3 different ways that we can do that from a generally accepted accounting point of view. First of all, we can use a straight line method, which is kind of what we used before, and that's really just proportional to time. So for instance, if we have a 5-year asset, 5-year useful life, each year we're just going to depreciate 1/5 of the cost each year. So that's pretty simple. Units of output is where we're going to look at depreciating the asset proportional to the output. So for instance, let's say we had a truck that was going to be driven 100,000 miles. That was its useful life. And let's say that in the first year, it's driven 30,000 miles. Therefore, what we would do is depreciate 30% of the cost in the first year. Okay, so just a different way of looking at it, where the output is more relevant than the simple passage of time. So on a building, passage of time is probably more important. On a truck or a machine, it's the amount of use that the truck or machine is undergoing that probably makes more sense in terms of depreciating and in terms of how much revenue it's producing. So the more miles you're driving the truck, then the more revenue it's producing, then therefore the more expense should be matched against that revenue by way of depreciation. So that does make sense. The other final method is what's called double declining balance. Double declining balance is an accelerated depreciation method. An accelerated meaning that what we can do is we can accelerate the depreciation expense and push it more towards the initial years in which we own the asset. So we'd have more depreciation expense in the earlier years and less in the later years. And the way we would do that is we actually take the rate at which we're depreciating the declining balance of the asset is at twice the straight line rate. So that's SL, that's straight line, twice the straight line rate. Now, why would we do that? Why would we use an accelerated depreciation method? Why would we want to accelerate the depreciation? Well, you could stop the recording and think about that. But why would you want more expense in the early year? Why would you want more expense as a general matter? And the reason for that is taxes. You would want to have more expenses in the early year. Right after buying the asset, you're going to get a bigger expense deduction. You're going to get a bigger tax deduction. So you're going to get a tax break, tax advantage from doing that. And you might ask, well, why? And it was because back when this was enacted, for various reasons, probably most likely, Congress decided that they wanted to incent individuals and companies to make investments that would obviously be good for the economy. And as a means of incenting investment, you would get this tax break. You'd get these quicker write-offs through depreciation. That would give you some tax advantages, and that would provide incentive to make those investments. So, in any event, that's an acceptable method. And when you prepare your tax return, if you have a business, if you have rental properties and so forth, you're entitled to use that accelerated depreciation method. You can also use it for generally accepted accounting principles for financial reporting. So let's see how these methods work. So let's take an example. On January 1st of 2017, we're going to purchase an asset for $20,000. That asset's going to have a residual value of $2,000. So in other words, that's what it's going to be worth at the end of its useful life. So basically what we're going to do is, if we subtract the two, that means what we're going to do is we're going to depreciate a total of $18,000. So we purchase it for 20. Someday it'll be worth 2. That's what's left over. That means we want to depreciate it from 20 down to 2. So the total amount that we're going to depreciate, or in other words, our depreciable cost, is going to be $18,000. And that's the most we're ever going to depreciate this asset under any method. We're going to depreciate a total of $18,000 over its life, and we're never going to depreciate below the $2,000. So those amounts are fixed amounts no matter what method we're going to use. Okay. The useful life in this case is going to be 4 years or 45,000 hours. That could be miles, it could be hours, it could be, some other type of measure. And the 45,000 hours are, we're just going to assume that they occur at these levels for these 4 years. Now, obviously, you would need to wait each year to see how many actual hours that machine ran before you could compute the depreciation expense. We're just going to make an assumption that we know how much that machine is going to be used in those 4 years, just for purposes of being able to do the computations. But in real life, obviously you couldn't do 2018 depreciation until the end of 2018 when you knew how many hours that machine actually operated. All right, what we're going to do for all these methods, and I'm going to just use one table. You'll probably need to do 3, but we're going to set it up in using this table, and this way we're going to have all the information we're ever going to need all in one table. Okay, so we're going to have the year, we're going to have depreciation expense for that year, we're going to have the balance of accumulated depreciation, which is just the running balance of depreciation expense, and then we're going to have the net book value, which is simply the total cost of $20,000 minus the accumulated depreciation balance. Okay, so on the day we purchased the asset on 1/1/17, we're going to have a value of that asset of $20,000. Now, and again, we're going to use the straight line method. That's the first method we're going to use. So at the end of 2017, so this would be on 12/31/17, we're going to make an entry, an adjusting entry to record depreciation. And under the straight line method, we're basically going to take the depreciable cost. So we're going to take $18,000 and we're going to divide that by 4. And we're going to come up with $4,500 per year. So we're going to, remember, we're only going to depreciate $18,000 over the 4 years. We're going to do each year 1/4. Since it's 4 years, 1/4 of the $18,000, that's going to give us $4,500. So this year, $4,500. The balance in our accumulated depreciation account then would also be $4,500. And if we subtract $20,000 minus our accumulated depreciation balance, we would get our net book value of $15,500. Now remember, this adjusting entry at 12/31 of 2017, remember, it's going to look like this, right? Debit depreciation expense, credit accumulated depreciation, $4,500. So that's where these numbers are coming from. So at the end of the year, we're going to be making this entry at the end of each year. And this table is really just setting forth what those entries, the effect of those entries are to calculate the amount of those entries. Okay? Okay, so I just moved the table up a little bit so we'd have a little more room. So in 2018, again, under straight line, we'd have the same amount of depreciation expense, $4,500. And we'd have the exact same depreciation expense entry. When we make that entry, debit depreciation expense, credit accumulated depreciation, our accumulated depreciation account is now going to be 2 amounts of $4,500. So our total balance in that account now is going to be $9,000. So it's going to be the amount from 2017 plus the amount from 2018. Now our net book value would be $20,000 minus the accumulated depreciation balance of 9. So our net book value now would be $11,000. That's what would show up on our balance sheet. So if we looked at our balance sheet, we would have, if we looked at our income statement, we'd have, on our income statement, we'd have $4,500 of expense. On our balance sheet, we'd have $9,000 of accumulated depreciation. We'd have $20,000 of gross value and a net book value of $11,000 at the end of 2018. So we can just go forward with that. 2019, we'd have the same amount, another entry for $4,500. That would increase our accumulated depreciation to $13,500. And if we subtract $13,500 from $20,000, we get $6,500. So our net book value is dropping to $6,500. And then we're going to finish this up on the next video.